In terms of financial planning, Dave Ramsey's Baby Steps is one of the most widely used frameworks. This framework has become popular because of its simplicity. All you have to do is follow the steps in order, checking off each one as you move along. But what's the best way to go? Should you follow the baby steps, or is there a better way? Hello and welcome back to the Finance Guardian channel. This video will reveal the truth about Dave Ramsey's Baby Steps. Do they work? To find out, hit that subscribe button and the bell beside it, and let's get started. Baby step number 1. Save $1,000 to start an emergency fund. You might think it's silly to begin by stashing $1,000 in the bank. After all, you could use that money to reduce debt. But Dave's reasoning behind the emergency fund baby step makes sense. All of us have faced unexpected expenses, and for some reason, they are more likely to happen after you've just taken steps to get rid of debt. To avoid using your credit cards to cover these unexpected costs, Dave recommends save a quick $1,000 and keep it aside as a buffer. But know this. The $1,000 emergency fund will not do as much as it did in 1992 when these baby steps were first created. Inflation has pushed this number much higher. Having the same protection and buying power as Dave recommended in 1992 would require an emergency savings of $2,115.52 in 2022. There's no question that you need an emergency savings fund before you start repaying debt. Knowing you have money to fall back on when things go wrong is your best defense against unplanned financial expenses. But to make Dave's Baby Step 1 more relevant today, you should have at least $1,500 in your emergency fund. In general, though, most people should strive for an emergency savings fund of $2,000 to be prepared to handle unexpected expenses and major financial emergencies soon if they arise. You might also want to consider putting your emergency fund in a money market account which is accessible to you and earns interest. Baby step number 2. Pay off all debt except your mortgage, using the debt snowball method. In this second step, Dave recommends using the debt snowball method, in which you make minimum payments on all your debts except the one you are paying off first. Your extra money should go toward the smallest debt with the lowest balance. As soon as you have paid off the smallest debt, you move on to the next lowest balance, and so on. This debt payoff method is a good starting point, but the problem with it is that it focuses only on people's psychology and motivation. If you want immediate results, this method is perfect for you. But if you are detail-oriented, this will drive you crazy. You will be compelled to pay more interest in your overall debt repayment plan by disregarding the high interest rates. Dave Ramsey looks solely at the amount of outstanding debt rather than the interest you pay each month. But in the end, it all boils down to picking an effective debt payoff method that suits your personal preferences and motivation. Baby step number 3. Save 3 to 6 months of expenses for emergencies. During baby step number 1, you made a beginner emergency fund so that if you get a sudden financial setback like an unexpected car repair, it won't spiral out of control. But other than that, you've also got to consider whether you can handle a more prolonged setback like losing your job. Here are a few thoughts on this particular baby step. Putting aside 6 months is a substantial amount of money for a beginner, and it may be more than you actually need. Assess your situation and risk and ensure that you consider everything. The most considerable risk for most people is losing their job, so you need to figure out just how big of a risk that is in your situation. Can you replace your job easily if your company announces layoffs, or would you have trouble replacing your current income? If you have low risk, you might be able to get by with just 3 months' worth of expenses. Baby step number 4. Invest 15% of your household income into a Roth IRA and pre-tax retirement fund. Now look at you. Your consumer debt is gone. You have an emergency fund that is now funded and contains enough funds for 3 to 6 months of expenses. The next step Ramsey recommends is to maximize your retirement investment. For a 2022, you can contribute up to the IRS maximum of $20,500 per year for 401ks and $6,000 per year for IRAs. Ramsey says you should save 15% of your income. This means an investment of $15,000 per year would be appropriate if you have a household income of $100,000. For those 50 and over, adding more cash to retirement accounts is possible. $6,500 to their 401k and $1,000 to their IRA holdings. Contributions such as these are called catch-up contributions. If you can make them, then do so. Maximizing your retirement investment helps you ensure your golden years will be comfortable. Baby step number 5. Save for your children's college fund. A good thing about Ramsey's baby step on college is that he makes clear that college alone does not guarantee career success for your children. You must weigh college costs and benefits before sending your kid to spend $25,000 a year on schooling. In this step, you must speak with your spouse about how much money you can set aside for your kids' education. How much to put into your kids' college fund is up to you. But take the time to research the various college savings options and be sure the amount you're planning to contribute is affordable for your family. For this, having an education savings account is also a good idea. You should also explain your college financing plan to your kids. I mean, they should know what to expect from you. Lastly, think about college alternatives to contributing to your kids' college fund. You might end up saving a ton of money. Baby step number 6. Pay off your home early. Once you're debt-free and investing for retirement, Dave recommends paying off your mortgage immediately. He recommends paying cash and avoiding a mortgage altogether. But realistically, most Americans will not be able to achieve this feat. So if you must get a mortgage, Dave suggests a conventional 15-year loan. Mathematically, investing the extra cash may make more sense than paying off the house sooner. But take a moment to think about it. You're already investing 15% of your income. What is more important to you? Would you rather have an already paid off house, no mortgage debt, plus financial independence, or earn 5% extra on the money and pay off your mortgage for another 15 plus years? Investing might make more sense mathematically, but life doesn't always work out that way. With no monthly house payment or home mortgage, you will have the financial peace of mind and security to handle just about any monetary issue. Baby step number 7. Build wealth and give. After years of prioritizing more foundational financial goals, once you reach this point, you have a whole world of possibilities ahead of you. There's no debt on your slate. You've got a nice savings account. So what does that mean? The time has come to build wealth. The process of building wealth can take many forms. You can invest in mutual funds, or you can do it with real estate. You can even put your money away in a high-interest earning bank if you wish. The end goal is to invest as much money as possible in whatever your financial goals are. That could mean traveling the world, building a dream home, or even living the life of a philanthropist. Now that you're debt-free, you're working on amassing wealth, and the world is your oyster. How does that sound? The Dave Ramsey Baby Step Framework's greatest value is its structure, since you can follow the steps one by one at your own pace and stay focused on what is important. If you follow the plan, you will be in a good position to achieve your financial goals. But remember, some problems may arise with this fixed structure, since every financial decision comes with an opportunity cost. Getting completely debt-free may mean allocating extra money to debt paydown efforts, which might not be the most efficient use of that money. Keep in mind that Ramsey is anti-debt in general, and these recommendations reflect that perspective. Besides, things don't always go as planned. Life changes fast, so it's a good idea to check in on yourself every now and then to make sure that you're on the right path. It's sometimes better to take a different route to reach your goals. And that is all the time that we have for today, folks. We hope you enjoyed this video, and if you did, please hit that like button. If you're new around here, subscribe to our channel to remain updated on all of our future videos. We'll see you next time.